What's going on, guys? This is Lior and welcome back to my channel. Now, what I thought I would do in this video is talk about some of the most common return metrics you'll see in deal analysis when evaluating multifamily. And then I'll also talk about which one should matter the most to you based on your personal financial goals, your investment thesis, and what you're trying to build up in your investment portfolio. So we'll break down those actual metrics, what you should concern with yourself, and we're gonna get after it right now. What's going on, guys? My name is Lior and welcome back to my channel. Now, before I get into the meat of the potatoes of the video, two super really quick things, guys. Number one, if this is your first time on my channel, first of all, welcome. My name is Lior. I'm a multifamily investor based here out of Boston, Massachusetts. And if this is your first time on my channel, make sure you subscribe. I put out weekly content all about multifamily investing, raising money, tax strategies, and literally everything in between. And then number two, guys, if you've been thinking about investing in real estate and specifically multifamily, and you want to invest in larger multifamily buildings, but you don't necessarily want to do all the work, you're too busy with your job and earning money, you don't want to be doing all the daily operational grind work, hit up me and my team in the link below, set up a call with us, and we can discuss if investing in some of our private placement multifamily deals could be the right for you, right? You could get passive income, equity upsides, and amazing tax benefits. So if you've been thinking investing passively, set up a call with me and my team, and we will definitely help you out. So let's get right into the meat and potatoes of the video. So let's start first by defining some of the more common return metrics that you'll see if you're evaluating a multifamily deal for yourself, or if you're looking at a kind of a multifamily syndication where you're going to invest passively. Here are the most common metrics that you will probably look at. Number one, let's get into it, is cash on cash, right? I mean, this is probably the metric that most people are most familiar with, right? And this is kind of the easiest to comprehend. It's how much cash flow am I getting on my invested capital, right? If I invest 100 grand into a deal, whether it's passively or I'm buying it myself, and I'm collecting $6,000 a year as passive income, then my cash on cash is 6%, right? I mean, that's a metric that everyone understands, that everyone uses, because they want to know how much passive income they're creating based on their invested capital. Number two metric that you're probably going to see is the equity multiple, right? And now we're kind of moving beyond just the cash flow that a property is producing and also talking about the proceeds that you can make on the actual sale, right? So because, with real estate, we of course invest for cash flow and that's amazing. But a lot of our returns are typically made when we sell the property, right? Because whether you're buying a value add deal or you're buying a deal in a great location that has some upside, and you sit on it, chances are your property is probably going to appreciate in value and you're going to make some profit on it. So equity multiple is kind of a nice cumulative way of looking at how much money really making on your invested capital, right? And it's usually based on a factor, right? So an equity multiple of 2, for example, would mean that let's say you invested $100,000 into a deal, all of the cash flows that you collect over the life of the investment, plus your profits at the end of the sale, right? So whatever you profited, that's going to be the ratio, right? So if you invest $100,000 and let's say you made between cash flow and profits, you also made $100,000 when you sold, right? So what's going to happen is at sale, you're going to make those profits, plus you're going to get your invested equity back. So you're going to get $200,000 back at closing. So that's going to give you an equity multiple of 2. So that's a pretty good equity multiple. Typically on syndications or multifamily investments, what we see is somewhere around the vicinity of 1.6, 1.7, 1.8, up to like 2, 2.1, 2.2, I think is kind of the standard range, lower to higher. Obviously you can have higher if the deal is absolutely crushing it, but generally that's where we like to see, right? Is we like to try to push towards that 2 number. So if someone writes a check for $100,000, they invest passively, for example, they're gonna get that $100,000 back plus $100,000 of profit. Now, let's move on to the third metric, which you're probably gonna see and gives a little bit more of a detailed story of how the investment is gonna play out than just a global equity multiple, is the average annual return, or AAR. Now, average annual return, the way essentially it's calculated is you're gonna look at your cash flows every single year, right? So let's say, again, for easy numbers, someone invests $100,000. Let's say for the first 4 years, they make $5,000 per year. So 5 for the first 4 years. And then let's say they make that $80,000 of profit on the sale on year 5, right? So essentially what you're gonna do is you're gonna calculate an average annualized return. So, that first year, $5,000 on 100 is gonna be 5%. And you're gonna kind of do that math every single year, including the last year. And then you're gonna average all of those annual returns over the life of the investment. There's a couple of things that you need to consider when evaluating this metric, right? So first of all, especially in value add deals or deals where there's a lot of equity upside, more than likely, most of your proceeds are gonna come at the sale, right? Because you've built up a lot of equity, you're gonna have a ton of profit. That annualized return number on that final year is gonna be significantly bigger than your annual return during the hold period when you're really just making the cash flow, right? So that number is definitely gonna drive the bulk of your returns. But what this allows you to do when you create this average annual return, right? What this allows you to do is kind of get a sense of like, okay, even though my proceeds are coming for most of them at year 5, right? When I sell, this is kind of on average what my money is going to produce for me on a year-to-year basis, right? So, it's obviously, you need to understand the caveats here that bulk is coming at the end. But if you wanted to kind of have a conceptual feel of what is my money producing on a year-to-year basis when I think about year 1 all the way through year 5 of me owning this property or me investing in this multifamily syndication, this is a good way to do it, right? And typical average annual returns, I would say, for multifamily, usually what I see is high teens to low and mid 20s, depending on how much value add there is and, the risk of the deal. So, it's kind of a cool way to think about it, right? Because even though your cash on cash returns, let's say for the first couple of years, really are only gonna be 5 or 6%, when you're kind of bulking in the proceeds you're gonna make at the profit on the sale at the very end, you can see that your average annualized return on your invested capital can be as high as 18, 20, 22, 24%, right? So your capital is actually working a lot harder than just that cash on cash. But of course, you don't realize the proceeds of the bulk of those proceeds until the sale. And finally, the last metric I'm really gonna touch on for this video is the IRR. Now, IRR, it's a complex metric, but essentially it is a metric that shows us how are the returns on a year-to-year basis, but we are also accounting for the time value of money. And basically what that means is, money that's gonna be returned to you faster, earlier, is gonna be worth to you more as an investor, right? Because, if I can get returned that $80,000 year 2 versus year 5, as an investor, that's fantastic, right? Because I can go redeploy that $80,000 and generate a return somewhere else on another investment, right? So IRR is a kind of a nice metric to compare from deal to deal, because not only does it account for all the cash flows, including your annual distributions and your profits at sale, there is also a nice metric that's sensitive to how quickly you can get that money back, right? Because speed is everything. If we can get that money back quicker in our pocket, we can go redeploy it and go get more returns on our capital. So now that I kind of ran at a high level some of the most important metrics, like how do you as an investor decide which ones should you prioritize? What, is there one that's should be more important to you? How do you prioritize them? And this kind of leads us to the discussion of you really need to understand what your investment goals and targets are, right? And here's what I mean by that. Let's say you're someone that really wants to create just a cash flow stream for you, right? That's really important. Maybe you want to quit your job, you want to retire, maybe you're nearing retirement age, and you just want consistent passive income. Well, what I would really prioritize, of course, would be the cash on cash, right? Because if I really care about generating the most amount of passive income from my investment, I want the highest possible returns on a year-to-year basis. So I am really going to prioritize that cash on cash return. But let's say I'm someone that's maybe younger or more aggressive in my portfolio, and I don't really need that, passive income stream. Let's say I'm making plenty of money on my job or in my business, and, additional income is great, but that's not really what I want to focus on. I want to focus on that upside, right? Well, if you're going to be focusing on that equity upside, then you're going to want to start to look at things like equity multiple, right? That's going to be very big, right? Because of course, you're looking at total returns on your invested capital, including the proceeds at sale. That's going to help you evaluate, all right, how much money am I actually making, on my invested capital at the end of the day, rather than just that passive income. So that's that. And then, of course, if you're someone that's kind of more of a professional investor, right? And you're really strategic about your cash. You want all your cash to be maximized at all different points, at all different times. Maybe you're going to be really sensitive to that IRR, right? Because you know that if you can get cash back really quick within a year or two, you can go. You're going to have other opportunities where you can go redeploy, right? So that would be a case where maybe I would focus on IRR, right? Because that's going to be a very time-sensitive metric. So you can see, just depending on how you're thinking about your investment strategy and philosophy, you're going to want to weigh these different metrics differently. Now, there's no one correct metric. Each one of these metrics tells you a different component of the deal, right? Cash on cash, of course, is the distributions, as we talked about. The equity multiple is more about the equity buildup. Then you've got your IRR and average annual return, right, which can kind of help you build a story of what are your cash flows going to look like in between, how much time is it going to take for you to make that money. So you can see, like, again, you can kind of lean in different ways depending on where you're coming from as an investor. So it's really, really important to align your investment philosophy, and based off that, you figure out which metrics kind of tell the most important story for yourself. So hopefully that's helpful, guys. Hopefully that makes sense. Of course, if you have any other questions about this, on how to evaluate these deals, what metrics, or what you should be focused on, either hit me up directly or make sure you put a comment in the comments below, and I will definitely help you out.